Did you know there is a way to make millions of dollars by sitting on your couch at home? This is through trading stocks in a stock exchange. The New York Stock Exchange is an American stock exchange system. It was made in 1792, and as technology upgraded, the efficiencies upgraded. In 1886, the trade volume hit 1 million shares. The stock market is a system where people can buy and sell shares of ownership of companies, which is called stocks. The stock market has grown over the years since the 1800s, and at its peak in 2020, there's 2,363 companies listed in the New York Stock Exchange. The trade market has been around for some time and it's grown a lot. I've done a lot of research on this topic. I've been very interested in it. I reviewed online sources and studies, and I learned the history and how it works. Today, I'll go over how to trade in the stock market. First, I'll define what stocks are and what the stock market is and how it works. Second, I'll explain the different market trends, economic indicators, and factors which affect market conditions. Last, I'll explain different strategies to invest in the stock market. Now, let's dive in and discuss stocks, the stock market, and how it works. So, what are stocks? Stocks are shares of publicly traded companies. So, when you own a stock, you technically own a part of a company. The percentage of the company you own depends on the number of stocks you own and how many shares the companies issue. People trade those stocks in the stock market. Investopedia's definition of the stock market is that it is an exchange mechanism that helps investors buy and sell shares of publicly traded companies. An example of publicly owned companies are Apple, Amazon, Alphabet, and Home Depot. Trading these shares are protected by laws against fraud and other unfair trade practices, making trading stocks fair, trustworthy, and reliable. In the stock market, prices of stocks are determined from the demand. Higher demand means higher prices, and vice versa. And this is how you can make money. The famous saying, buy low and sell high. You can also make money from specific companies who pay out dividends periodically. Dividends are payments that companies pay out to their owners, like loyalty rewards. Stock trading affects the economy and keeps money flowing. And companies sell shares of their company to generate money. This money can go to, like, say, new businesses like fast startups, paying off debts, business operations, and more. The better the company does, the higher demand for their stocks, and it raises the price and value. And investors overall gain wealth. So, in a perfect scenario, it's a win-win for the business and for the investors. However, if the stock market crashes, the economy falls, and in extreme cases, fall into a recession. Now, we understand the basics of stocks, stock markets. Now, let's get into the different market trends, indicators, and factors that affect the market conditions. Two types of market trends are the bull markets and bear markets. The bull markets are periods when stock prices are rising. This raises the investor's confidence in the market's success and overall leads to profit. Now, the bear market is the exact opposite. This is when the period of stock prices are falling. This is the loss in confidence of the market success, and the economy can slow down and even fall into recession. The key to investing is to understand what specific market phase that it's in, and you can strategize accordingly. Next are different economic indicators. These can tell investors the health of the market. So the first indicator is interest rates. Interest rates affect the cost of borrowing money. The rate is set by the banks who lend out money. And the low rates make it cheap for businesses and individuals to borrow money. So low rates benefit the stock market. Since businesses are borrowing for cheaper, it can lead to profit. Consumers are also willing to spend more since they're borrowing for less. Now, high interest rates do the opposite and negatively affect the stock market. The second indicator is inflation. Inflation is the decrease in the purchase power of the dollar. The high inflation means the dollar loses a lot of its purchasing power, and things become more expensive. Moderate inflation is a sign of a growing economy, and it's healthy to have a little bit of inflation. Now, low inflation means it's a stable economy, and the purchase power is stable. The good levels to invest in are the low inflation rates and moderate inflation rates. Now, next indicator is GDP, which is gross domestic product. GDP measures countries' total economic output. High GDP means businesses are performing well and have a good output, which overall means the stock market is also performing well. Now, there are ways to tell how specific business and market are also performing. And this is a look into a company's financial statements. Publicly owned businesses, which trade stocks and shares of their company, also have to, their financial documents are open to the public, so you can gain insight in specific industries and businesses. And there's different financial documents like the income statement and balance sheet. The income statement tells us the revenue, expenses, and profit of a company, and it's a direct tell of how well the company is doing. The balance sheet tells us the assets, liabilities, and equity of a company. The assets are the positive things in a company like money, equipment, and other things. Liabilities are the negatives, which is like debt and obligations. And equity is just assets minus liabilities. And equity is the ownership value of the company, so if it's good to invest. These give a direct insight on how well a company is performing. But outside of a specific company, you can browse the news and other reports. So economic reports can tell us the economic indicators directly. Now, news can tell us companies' announcements, stock updates, and more, and just on specific things, just like industry updates and news. Global events in the news can affect specific industries and how well their stocks are doing. Another thing are government regulations and policies may change, and they are told out in the news as well. These are things like interest rates, tax rates, and more, which can change and affect how businesses are performing. Analyzing news gives investors a look on the surrounding environment so they can have a hint of where the stocks of businesses are going to rise or fall. Now that we understand market trends, economic indicators, and how to analyze the market, we can start to form strategies, which is the last step. One of the biggest rules in investing is to diversify your portfolio, and it's not putting all your eggs in one basket. By entering multiple markets, if one industry plummets, you don't lose all of your eggs or all your money. This reduces the risk. And there's always going to be a risk, but you decide how much you take on or assume. You do this by taking a risk assessment. It's the process of identifying, analyzing, and evaluating potential risks associated with specific industries. Then, after this, you do a risk tolerance assessment, which is how much risk that you are willing to take on. The less riskier the portfolio means there's less volatility and it's safer. The markets are more stable and less likely to lose money, but it's less likely to make a huge profit. The more risky your portfolio is, the more money that you can ultimately make. You make big profits, but you can also have a very big loss. There are different strategies you can pick from which will help you formulate an investment portfolio. First one is a value investing, which is a long-term investment plan. It identifies companies with strong management, values, and a competitive edge. It holds undervalued stocks. You hold the undervalued stocks until they rise, and it's safer. It's on the safer side since the stocks are cheaper. The second option is growth investing, which focuses on companies with high potential of growth. Examples of this are like technology or new energy sources. It's a riskier type of investing since they could be more expensive stocks and they may not even grow. The last one is dividend investing, where you invest in stocks that pay out dividends. Investors can receive these dividends and reinvest it into other stocks. It's a source of passive income, and it's a low risk plan. There are different strategies and ways to invest which are unique to your own interest. So overall today, I explained how to invest in the stock market. I defined what stocks are and what the stock market is and how it works. I identified different indicators, factors, and ways to analyze the market conditions. I also talked about ways of forming different strategies to invest and how much risk you want to take on. The stock market is a great way to make money over time from your home and has the ability to change your life. Thank you. And these are my note cards. Boom, 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 boom. Thank you.